Good morning. Today's walk's going to be on commercial banking. Not the kind of business that's hard to explain. You'll get it pretty quickly, but it's the kind of business that's surprisingly hard to transform, especially through technology, which is my intent on this walk. To talk about commercial banking through the lens of generative AI within the context of the current life cycle of a commercial loan. I'll say from the get-go that commercial banking is a relationship business, and tech is usually an efficiency multiplier, not a relationship multiplier. If anything, digital transformation tends to broaden, not deepen, relationships, which is another way of saying that there's a real risk of tech negatively impacting commercial relationships. An everyday banking example of that would be every old school bank, consumer bank, is trying desperately to redirect you from their banking centers, those buildings with tellers, to their mobile apps and digital platforms. They're doing it to become more efficient. Tech as efficiency multiplier. Save on rent, paying tellers, etc. And every step the larger banks take toward eliminating their physical footprint, well, they lose the human connection in banking. And consequently, their ability to differentiate from digital first, digital only banks. So, as I said, tech, without being more mindful and human connection centric, is usually an efficiency multiplier, not a relationship multiplier. Okay, so if you're not familiar with commercial banking or commercial lending, let's do a quick overview, even if it's painfully obvious. Commercial lending is the process of making loans to businesses. That's commercial banking, rather than loans to individuals, consumer banking. This type of lending allows businesses to borrow money to finance anything from purchasing inventory to expanding operations to investing in new equipment, really anything a business needs to grow. Commercial loans have typically higher interest rates compared to consumer loans due to the higher risk associated with lending to businesses. And I get that that doesn't sound right intuitively because an individual has less money than a business. But remember, businesses borrow exponentially more money and more regularly than consumers. So they have a higher likelihood of defaulting on their loans, not paying them, because they're more sensitive to a long list of things: economic downturns, market fluctuations, changes in industry trends, poor management, bad planning, competition from digital first startups. Also, and again, this might sound counterintuitive, but businesses may have less stable income compared to individuals. And I don't just mean little tiny businesses. I mean all businesses of all sizes, especially if you look at the relative size of the loans that they take versus you and I take. You and me, biggest loans we might take are like a mortgage. Business, well, think factory or robotics or payroll. Capital intensive, which is a fancy way of saying way more expensive than your mortgage or mine. Hi. And compare the regularity of income. You and me, we get a regular paycheck. A business, their levels of cash on hand can vary greatly from day to day, month to month, quarter to quarter. So a bank correctly views business loans as higher risk. They understand that businesses are less likely to meet their loan obligations. And that comes back to higher interest rates on commercial loans to compensate for all that increased risk. Look, that's part of it. The other part is that banks aren't stupid. They understand the competitive landscape for money, for loans, and they realize that businesses need the loans, capital and need. And when you have that kind of demand, you can charge a premium for it. Yes, businesses' creditworthiness is a factor. We'll get into that when we talk life cycle. The bank's going to want to do some close review of the company's financials, their statements, their future projections, and really, depending on the size of the loan, the bank might even want to review the company's business plan for that money. They might want to insist on a certain level of maturity in the company's financial management. All of that helps reduce the risks to the bank. And that process, as rigorous as it is, really facilitates the company's chances of being approved for a loan. But there will still be a premium on that loan, regardless of how rigorous that process is. So commercial banking is lucrative. They should have just said that. How lucrative? This year, the global commercial banking market is estimated to be $2.24 trillion. That's with a T, dollars. And it's expected to reach $3.81 trillion by 2028. It's a lot of money. The business world has an unquenchable thirst for loans for everything from financing inventory to expanding operations. So, as I said, high demand, which I also said, like 20 feet back, allows banks to charge a premium for providing those loans. One quick definition before we jump. What's a credit facility? And is it different than a commercial loan? Credit facility is a type of commercial loan. It provides the borrower with a revolving line of credit. This means that the business can borrow funds, repay them, and borrow again up to a predetermined credit limit without the hassle of all the bureaucratic steps in a single loan process, happening every time you need another loan. A credit facility is more flexible than a traditional commercial loan because it allows the borrower to spend the funds as needed and only pay interest on the amount borrowed. In contrast, a traditional commercial loan provides the borrower with a lump sum of money that must be repaid in regular installments over a fixed period of time. Once repaid, that deal's done. You want another deal? Fill out another form. A credit facility, on the other hand, is like your parents' credit card. You can use it, you have to pay the bill, but if you do, pay the bill, you can use it again. Credit facility. All right, let's talk operational life cycle. At a bank, the life cycle of a commercial loan is typically divided into several stages. The first stage is the application process, where the business submits a loan application, just like a mortgage application, but for a business loan, with, their relevant financial information and documents. Once the application is received, the lender reviews the business's creditworthiness, as I mentioned already, and evaluates the potential risks involved in lending to that particular business. If the application is approved, the loan moves to the next stage, which is the underwriting process. During underwriting, the lender performs a much more detailed analysis of the business's financial statements. Think serious due diligence. They look at financial statements, cash flows, collateral, anything really that can shed light on the risk to the money being loaned. And all that's done not just to say yes or no to the loan, which is the next step, but to factor in thoughtful terms and conditions for that loan, thoughtful to the bank and its legions of lawyers. His stage also involves requesting additional documentation and conducting site visits or property appraisals, anything that will give the bank peace of mind about the risk they have to take. What would be next? The loan approval process, which I mentioned, which is why you were doing that due diligence, right? That underwriting. The approval process is where the lender determines whether or not to give out the loan based on the information gathered during underwriting. If approved, the lender will provide the borrower with the loan agreement, a contract that outlines the terms and conditions that they've come up with through underwriting with the help of all their lawyers. Once the loan agreement is signed, the funds are disbursed to the borrower, marking the funding stage. The borrower can then use the funds for the intended purpose, whether it's, purchasing inventory, expanding operations, investing in new equipment, which I've said like multiple times now. Whatever they took the money out for, they can now spend it. And like with your mortgage, throughout the life of the loan, the borrower is responsible for making regular payments according to the agreed upon schedule in that contract. There's a lot of complexity in one step of that process. I should have given it a lot more time on the walk. The underwriting steps. And that's mostly because underwriting, for as complex as it is mostly a human-heavy process operationally. The process for gathering data about the business that's applying for the loan and all the legal jargon is standardized and mostly automated. But depending on which human underwriter or underwriting team gets that workflow step, the ultimate thumbs up or thumbs down on the loan is dependent on human judgment. That human or team thoroughly evaluates the borrower's financial information to assess creditworthiness and determine suitable terms and conditions, as I said, for the loan. That human or team analyzes financial statements, cash flows, collateral. That's some serious complexity. And they're responsible for all the other factors that lend themselves to making an informed decision. It's even up to that human's discretion to request additional documentation, the underwriter's discretion, which they, the underwriter, would review once the business submitted it. Human underwriters, guided by smart policies and controls and a ton of training, ensure that the bank mitigates risk and provides loans to businesses with a high likelihood of repayment. Let's call that whole step underwriting. Let's call it more art than science. You definitely risk the hungry judge effect, the idea that judges in the court systems, at least, are more inclined to be lenient after a meal and more severe before their meal break. Suffice to say, to run an effective commercial banking shop, the bank needs to establish clear processes and procedures, hire really smart underwriters, train them continuously, have a dedicated team that handles the application loans, a separate team that is focused on approvals, a separate team that's focused on disbursement, and have them all be aware of the end to end. They should, all the teams, have a good sense of the bank's lending policies and guidelines for their customers. No duh. And it's important for everyone in those sets of teams to stay updated on industry trends and, drumroll, regulations that may impact commercial lending. It's everyone's job. Okay. Ops aside, what do businesses look for in a banking partner for commercial loans? Let's explore the obvious. Businesses look for experience and expertise. They prefer banks that have a demonstrated track record and expertise in commercial lending. But they really want a banking partner that understands their industry, not banking, like shoemaking. They need someone who understands their company's history, their specific needs. So their banking partner can use that information to tailor a custom solution for their business. That's why relationships are so important. The deeper, the better. The CFO of a company might say, I've known Banker Bob for years and trust him. But what underlies that statement is Banker Bob knows my business. He knows my constraints and he trusts me. Can a robo-lender earn that kind of trust? Maybe. If that system is designed intentionally from the ground up. What are the factors do customers look for, or clients or businesses look for in a commercial bank or in a banking partner? Competitive interest rates and terms. Businesses, like all of us, are looking to save a buck. They're looking for flexibility on repayment terms. And because everyone likes to feel special, favorable loan conditions. They want to ensure that they can afford the loan and that it aligns with their company's financial goals. Banker Bob can do that because there's history there between him and the CFO, a deep business relationship. Can a robo-lender do that? Maybe. Again, if it's designed intentionally from the ground up to be relationship building, human connection centric. What else? Quick and efficient loan processing. No one wants to wait forever. So businesses value banks that have streamlined and efficient loan processing systems. If you're going to wait for the Star Wars ride at Disney, you don't want to wait for 5 hours. The typical bank loan can take weeks to process or months. Some banks differentiate by demonstrating that they can fund within a week of a business submitting an application. This, I think, is where a robo-lender really shines. Products like Rocket Mortgage, which is also a little bit of marketing misdirection because it's their application process that's fast, while their underwriting still takes up to a week. I love that I said underwriting instead of underwriting. The emphasis on the wrong syllable. Okay, the tech challenge is to automate underwriting, to evolve from a human-centric, SME-centric, and SME's subject matter expert, SME. So to evolve from a human-centric, SME-centric process that takes hours and days to an AI or algo that evaluates risk within milliseconds, that forms terms and conditions to address those risks within milliseconds. But I'm getting ahead of myself. What else do businesses look for in a banking partner for commercial loans? Responsive customer service. Does a human pick up a phone? Is that human useful? Once they've picked up a phone, everyone appreciates responsiveness and personalized customer service. And the more complex the product, the greater the need that the person picking up the call is a SME, a subject matter expert. In consumer banking, the call center gets asked questions like, what's my balance? Or what's this charge about? But in commercial banking, questions would be much harder to answer. Given today's contract-centric world in commercial banking, where each loan could be not just a contract, but one that's a snowflake that's been customized for a specific client, or more accurately, customized to address specific risks with that deal. The SME, that poor person picking up the call in the call center, would need to read that contract in real time or to quickly isolate the parts of the contract that they need to read in real time, making it hard for them to, answer what are essentially legal questions in real time. Lawyers can't even do that or have been trained not to do that. Again, getting ahead of myself, but the industry needs to move from contract-centric to data-centric, from giant blobs of legal text that describe the product or service to something the average call center employee can use in real time. Because without that, you have to direct all calls to the deal team, and they're hopefully already busy working on the next 10 deals. So rerouting questions to the deal team or to lawyers doesn't scale. Call centers scale. But the products they support need to be simplified with support in mind, because just picking up a call quickly doesn't mean greater customer service or customer satisfaction. What else? Note, I haven't explicitly called it out with everything I've talked and walked about so far, but we've actually been covering themes like relationship building, or why relationship building is important. Who doesn't value their lending partner taking the time to understand their business? We've covered why industry knowledge is important. Who doesn't value a partner who has a deep understanding of their industry and can provide valuable insights and make intros? We can infer from those two things that a deep relationship with a lending partner who really understands your space can lead to them offering strategic advice and strategic connections, connecting you with other professionals or resources that can enhance your business growth. It's like private equity, right? Very relationship-based. Think relationship centricity. But let's continue. Businesses, what do they look for in a banking partner for commercial loans? I think I touched on flexibility already, but let's pound that home. Flexible financing options. Cookie cutter options are great if you're a cookie. Humans prefer banking partners that offer a variety of financing options to meet their specific needs. Whether it's a term loan, line of credit, equipment financing, businesses need the flexibility to choose the most suitable option for them. What else? Oh, super obvious. Digital banking capabilities. There isn't a CFO out there thinking, I should be able to use my personal phone to pay my company's bills. But every CFO is thinking, why are my systems not fully integrated with my banking partner systems? They're thinking, Yeah, my bank offers APIs, and I don't have a bunch of developers to actually use them. Don't even get me started. Not on this walk. Don't get me started on the arrogance of offering APIs as a solution. Uh, the arrogance of banks offering convenient online and mobile banking platforms when the business owner doesn't live their digital life in the bank's properties. Anyhow, if I'm just listing expectations, digital is in there because, in theory, it allows businesses to easily manage their accounts, make payments, access important financial documents and information, or so every bank keeps telling you. What else? Stability and resiliency, a strong reputation, both in the financial sense and in their tech. Think reliable, trustworthy, 24/7 by 365 throughout the duration of the process and the loan. And I can go on forever. So I'll do one last what do customers look for? And we'll end with an ability to meet funding needs. If you're a giant co, you're probably not going to browse to fintech.com for your massive lending needs. You'll flirt with them to get better rates from the big guys, but that's just good negotiation. Point here is that different sized businesses look for different sized banking partners, ones that have the capacity to meet their specific funding needs. Whether it's a small loan or a large financing requirement, businesses want to ensure that their bank has the resources, the scale, the business capabilities to provide the money. Before I jump off, this point is probably worth noting, and it's pretty well known in banking circles, that small and medium-sized enterprises, businesses, have a relatively disengaged relationship with their banks. Accenture published some research that said that 47% of small and medium-sized businesses believe that banks don't try to understand their challenges. Only 9% are comfortable that their current bank meets all their needs. That's a huge gap, a huge market opportunity. Let's frame it positively. Huge market opportunity for entrepreneurs or intrapreneurs. Anyway, I ended on that because large lenders have an economic advantage over small or smaller or nimbler lenders, which is one explanation for why startups aren't yet eating commercial lenders' lunch. Large lenders can and do offer lower rates because they can and do take advantage of economies of scale. They can and do get volume discounts on their money. They can and do access cheaper or more abundant capital. That's important to remember because the value of a digital first, fully automated, easy process isn't yet enough to change entrenched business behavior. Another way to think about it, if you're a big, slow-moving beast of a business, you probably don't mind partnering with a big, slow-moving beast of a bank. No one wants to be a big, slow-moving beast of a business. And the final way to think about it, and this you should probably get a tattoo on your arm, relationships are always more important than transactions. It's not just that Bob the banker has an advantage. Bob is the advantage. Also worth noting, 2 words, trade finance. If you don't know what that means, trade finance is banking jargon that describes different strategies employed to make international trade easier. Digital payments, for instance. It's financing for trade financing. or trade finance. Let's think domestic and international trade transactions. Think services for the sellers and buyers of goods. Anywho, trade finance isn't exactly a hotbed of innovation, but customers have come to expect more and better. Startups, or what bankers called non-traditional competitors, aren't yet putting the traditional players out of business, but Accenture put out this report last year called something like Finding Your Competitive Advantage in Trade Finance, something like that. And in that report, they talked about how 40+% of North American banking customers said fintechs were a workable alternative to bank-provided payment services. If you're in the treasury management business, that should scare you. That same report listed all the reasons that survey respondents cited about why they might choose a fintech over a bank. Cost was the number one reason. High 50s in terms of the percentage of respondents who mentioned cost as the reason they're looking past banks. Digital capabilities, 30-odd%. Ease of use, low 50-ish%. Ease of integration, 40%-ish. Those are big numbers that have, I think, lit the fire under banking's ass. Every commercial client is under the impression that banks can do better. And every commercial bank is now under pressure to address the gaping holes in trade finance. And the more entrants and the slicker the tech of each new competitor, the more trade finance as a function is stepping up their investments in technology, hopefully, and stepping up their product offerings, hopefully. That's my way of saying that it's the right time to have this next part of the walk. How can AI radically improve the commercial loan experience end to end? Think generative AI. Think of it as the mother of all Google searches across all the documents you already store, but it's also a time machine. It can gather relevant information from applicants even before they apply for future loans. AI can reduce the need for manual data entry once they do apply, streamlining the application process, again, even before the client applies for the loan. Stop. Let me rewind. It might have made sense for a walk like this to start the application of AI when the client expresses an interest in a commercial loan. That's yesterday's thinking. It's too late. Step one should be to leverage AI for prospecting and sales. One, for organic sales growth with clients you already have, and two, for finding new prospects. So organic growth first. And if you don't know what organic growth means, it's a fancy way of saying, let's try to get more money from the clients we already have, sometimes called deepening your share of wallet. The banking equivalent of, do you want fries or that burger? Because when your client's wallet is already open, that's the best time to sell them more or to sell them adjacent products, fries for every burgers. That's organic growth. So if your bank already has, say, 10,000 clients, whether they've taken commercial loans out from you in the past or not, it doesn't matter. You can feed an LLM, a large language model, an AI platform. You can feed their profiles, your clients' profiles, into that platform. Might even be as easy as feeding the LLM their previous contracts, those massive, complex PDFs and Word documents filled with legal jargon and fee schedules. You'll also want to feed the LLM your risk boundaries, also in the form of a PDF or a Word document, and then craft some clever prompts that synthesize the data in those documents into a prospect list, a list of who to call for sales. There's little risk of the AI hallucinating because you're feeding it the unstructured text that you want to use, i.e., a client's previous contracts, their past and current financial information, any supporting documents they provided earlier, even notes from your own underwriters when they were trying to evaluate previous deals. And you're allowing the AI to infer what's risky about the client from that unstructured data. And I laugh because the ease with which you can do that is it's going to create a nightmare for making tech investments in your legacy applications. You shouldn't have 1 million contracts in your contracts database. You should move that whole contract writing process from its analog, let's just write a doc process, to something more like, let's capture all the data and rules for creating that doc. But once your business sees an LLM's ability to infer from that unstructured mess of a contract, they'll be hesitant to change their analog habits. They'll blame it on how expensive and disruptive the change will be, but it's an excuse to keep the process or processes that they grew up with. So LLMs unintentionally will increase technical debt in every organization that employs them. But let's keep going. Generative AI has now produced a list of clients, people to call to offer new loans to proactively before they reach out to say they need one. It almost doesn't matter, by the way, if the AI suggestions are correct, because it lights a fire under the banker's ass. The salesperson is forced to reach out and, if nothing else, talk about how cool it is that their company's generative AI has asked him or her to call that client. That's relationship deepening. And the best kind, because the client will be both spooked and impressed. This is a rare example of how tech can be designed to be both an efficiency multiplier, sales enablement improves as a result of this, and tech can be a relationship multiplier because it facilitates positive human connection, deepening relationships. It gives two people a reason to talk to each other, to engage one another, a reason that's important to both of them. And I know I call that step 1, but really, if you look at it, it's step 0.5. We're not even at step 1 yet in the life cycle of the loan traditionally defined. And it's a great example of the art of the possible. Let's go to step 1. In the old world, if the client was ready to start the loan process, they'd have to fill out all kinds of forms. No need in the age of AI. The same kind of prompt engineering that got you the list of prospects can be leveraged to produce the actual applications that need to be filled out. How? By feeding the LLM the unstructured garbage in your contracts repository and your CRM systems, then engineering a prompt that asks for the data in each contract. In other words, reverse engineer the thoughtfulness that should have but didn't transform your rickety contracts management platform into a data management platform years ago. For the data nerds watching, That's also how you populate and or validate your client master, your programmatically available golden source for client data. To your relationship managers, the like, the client's role goes from a tedious data entry specialist to a more sophisticated data reviewer. Next step in the life cycle, AI can reanalyze the client's data to assess their creditworthiness more accurately and efficiently than traditional underwriting. Not through generative AI, but through custom algos and predictive modeling, banks can make faster and more informed decisions about loan approvals, minimizing the time that it usually takes to receive a response, down from weeks and months to milliseconds. So, in that last step, where the client is just making sure that all the data in their form is right, the form that we filled out with generative AI, once they're sure it is right, and they hit the proverbial submit button, the underwriting process feels to them like it's done. Why? Because it was done before the deal was put in front of the client. By leveraging this proactive model, the banker doesn't need to engage underwriting because the AI algos have already analyzed vast amounts of data, those financial statements I mentioned, current market trends, current industry benchmarks. The model has already assessed the risk associated with the loan. The human underwriter's job transforms from keeper of tribal knowledge to the memorializer of that same knowledge, from judge to lawmaker. The function upgrades from risk management to risk model management. What's cool is that underwriting stops being the operational bottleneck because the bank has in essence already made a more informed decision about interest rates and loan terms and collateral requirements, even before their client has come to them hat in hand. And what's super cool is that LLM's chatbot capabilities, think Chat GPT, except not Chat GPT itself, that chatbot capability on all those documents we just fed it just gave you and your customers access to better data, an enabling tool that lets companies slice and dice their data, giving both lender and lendee competitive edge. I mean, if you really want to keep ideating, LLMs can even identify potential fraud or suspicious activities, further mitigating risks for the bank, but I'll stop there. Remember how at the beginning of the walk, I talked about the difference between a commercial loan and a credit facility? Remember how when a business takes out a single loan, if they want another one, they need to apply again and go through the hassle again? Remember how I talked about a credit facility being like your parents' credit card, how you can use it, pay the bill, use it again? Well, what I just outlined in that little bit of ideation with the potential uses of AI can turn every one-off commercial loan into a properly risk-managed credit facility. And that deserves a hallelujah from every business person on the planet who has ever filled out a loan application, or worse, filled it out again. Look, this walk isn't and has never been about improving the customer experience. This isn't about increasing the efficiency of the bank's lending operations. This is a complete reimagining of the end-to-end without the constraints of having to first modernize your legacy platforms. If you're an engineer, the whole notion of real-time calculation or real-time processing is yesterday's engineering ambition. Real-time with AI is too late. The paperwork is already complete and accurate 2 steps earlier in the business workflow. The chances of errors or missing information are resolved at step one in the data supply chain. Will that lead to faster loan disbursements? If anything, you need to put in control so it doesn't happen too fast. And the best part, just like AI would change the client's role from a tedious data entry specialist to a more sophisticated data reviewer, AI can and will change every operations role on the bank side from a tedious manual reconciler to a more sophisticated decision scientist. That's a change that's long overdue. Back office operations need to enhance their employee experience. What I've talked about will necessarily revitalize the poor folks doing all the hard work. And it'll attract fresh faces to the industry, people like you who are watching this, all of whom will come with strong digital competencies. That's a pretty hopeful place to end the walk. I hope you learned something.